Hello, I'm Bryce Knorr, Senior Editor of Farm Futures Magazine, and welcome to The Buzz for Wednesday, September 12th, 2012. Market analyst Arlan Suderman joins me from Husker Harvest Days in Grand Island, Nebraska, to discuss a USDA report released this morning that had a little something for everyone. Bulls were certainly most enthusiastic about the agency's soybean forecast. Futures rallied sharply after the government cut its estimate of both old crop ending stocks and new crop production, reducing supplies available to the market for 2012 by 72 million bushels. While that may not sound like much in a year when every last soybean is important, it suggests the market has a lot of work to do to ration demand. Here's how USDA arrived at its numbers. First, economists raised the forecast of old crop exports and crush by a combined total of 25 million bushels. Then they trimmed demand by 10 million by lowering residual use to just 3 million bushels. That means 130 million bushels were left over when the 2012 crop marketing year began on September 1st. Next, USDA lowered its estimate of new crop production by 58 million bushels, cutting the nationwide yield by 0.8 of a bushel to 35.3 bushels per acre. But rather than lower 2012 ending crop stocks any more than its already bare bones 115 million bushels, USDA said exports and crush would fall to keep stocks from running below pipeline minimums. After selling off this week, November futures reversed higher as traders apparently believe the only way to stretch supplies will be with increased prices. Arlan, the market made a new all-time high last week. Are we headed for another new record?
Yeah, Bryce, we're here at Husker Harvest Days in Grand Island, Nebraska, and as you can tell, we have a good crowd today, but the wind is blowing. So you asked about the soybean prices. Of course, we had a big response to USDA's crop report, and I think that caught some traders by surprise how big a response we had. Basically, fund managers seem to grasp the supply and demand fundamentals of soybeans much better than they do for corn. They understand that demand must be rationed by prices, that USDA can't take stocks too low. They have to cut demand, but it's a job of the marketplace to do that. So then the question begs, as you asked, what price will it take to do it? And I think it will take record high prices. And in fact, when we look what's actually happening to demand, we're seeing crush margins that are very profitable right now because of the lack of protein in the market. The absence of DDGs because ethanol production has slowed down is sending livestock producers to the soy meal market. That's really pushing those crush margins higher. Processors are battling exporters for every bushel because it's profitable to process. So we're actually increasing demand. What price will it take? I think it'll take a price north of $20 in soybean futures in order to start slowing demand, but it could be much higher than that. It all comes down to China. China has booked 65% of the new crop soybeans. We've already booked over 60% of this coming year's exports already, 65% of that going to China. Our crush processors are trying to buy every bushel they can. We haven't slowed demand, and once China slows, and I think that'll be somewhere north of $20, their buying power is 25% higher than it was in 2008 when they paid over $20 for U.S. soybeans delivered. Their futures prices are trading well over $21 right now. I think we're going higher.
If the bean numbers were clearly bullish, the opposite was true for corn. Not surprisingly, then, the market sold off in the wake of the news. USDA raised its forecast for September 1st old crop carryout more than we expected. In addition to cutting its forecast of exports, the agency made an unusual cut to feed usage, saying the fast pace of early new crop harvest in August reduced usage of old crop corn by 150 million bushels. While USDA raised its forecast of new crop feed usage, it added back only half that amount and said exports would be weaker too. Finally, the agency made only a token adjustment to its 2012 yield adjustment, cutting production by just 52 million bushels, lowering the national yield by 0.6 of a bushel and keeping harvested acreage unchanged. Bottom line, 2012 crop carryout went up 83 million bushels, knocking 30 million bushels a cent off USDA's average price for the crop, which went to $7.90. There's plenty to disagree with in USDA's analysis, but whatever you think of the agency's math, it appears demand will need to be cut severely. The question is, Arlan, what will it take to accomplish that objective?
Well, the trade really has had a difficult time getting a grasp of exports because they see exports on demand overall for corn. They've seen exports slow dramatically, and so they say, okay, we're seeing demand rationing. And yes, we have slowed ethanol production some as well. But when you start doing the math, you start looking at how much we've decreased exports, how much we've decreased ethanol, and I think that ethanol production is going to bounce as new crop supplies become available. And then when you look at what we're doing with feed demand, I don't think we're anywhere close to reaching the objectives, nor do we need to make the balance sheet work as USDA says. And then if you lower production more, as we believe it is, with harvested acreage, another 3.5 million acres below where USDA currently is, I think it's going to take higher prices. How high prices? I think it's going to take over $9 corn to sufficiently slow the ethanol production that we need to make the balance sheet work, even if politicians or government officials waive the RFS. So I think it's going to take higher corn prices. Now, does that happen next week? Probably not. Is it next month? Maybe not. It may be next spring before that happens, but eventually price is going to have to make sure demand does not exceed supply, and that's not the case right now.
Wheat prices looked like they were trying to break out on their price charts earlier this week, showing some independence after trading mostly in lockstep with corn this summer. However, the reaction to today's USDA report suggests wheat isn't ready to take off its training wheels yet. The government made no changes to its overall supply and demand tables, though some of the individual classes were jiggered a bit. The agency's world numbers also didn't cause much of a stir. It made no changes to Australian production and cut output out of the Black Sea by only 150 million bushels. Still, there's a growing sense that big importers, especially out of the Middle East and North Africa, are getting nervous. Panic may be too strong a word right now, but Egypt held its sixth tender this week since August, taking some French wheat in addition. That's the first real indication that Black Sea supplies are starting to run out. Also running out this week is the price discovery period for winter wheat revenue protection. Growers should enjoy another strong base price guarantee as they step up seeding the 2013 crop. Rains moving through the Midwest this week could improve conditions as well. Will this be enough to convince farmers to increase seedings, as our survey found last month, Arlan?
That's an excellent question, Bryce, because in the plains, when your summer crops burn up, you want to plant fence row to fence row wheat, and farmers certainly want to do that. And we have had some showers, and there will be some more showers. They're actively trying to take advantage of that moisture to try to prepare the seed beds, which the drought did not allow them to do it. And I think they'd like to increase wheat acres, but they have a problem. If you drive through the region, there are tens and tens and tens of thousands of acres where farmers went in and double cropped soybeans trying to take advantage of the high soybean price. Those soybeans now, after recent showers, are just peaking above the stubble. They're not going to produce, but you can't burn the stubble to remove it. You can't plant wheat in that stubble. There's not enough moisture or time now to try to work that down and get a seed bed out of it. Some farmers are trying to bale it to remove it, but that could limit how much we expand winter wheat acres. I think it'll be interesting to see how it all plays out. We may not see as big of an increase as we otherwise might expect.
Well, thanks, Arlan, and have a safe trip home to Wichita. I'll be back next week with another edition of The Buzz.